right, folks, going back here to the Diagnostic Trading Hour. And let's check out what's happening in the markets right now and talk about the big story of the day. We got the S&P. It is currently down 14 points. The Russell is down 21. NASDAQ's down 45. Dow's down 75 points on the day. Russell getting hammered the most, down almost 2% at the moment. We got copper. All the metals been just flying. Copper's up 2%. Gold's up 2%. Silver is up 0.5% today. All that relating to one specific announcement. We got natural gas is down over 0.5%. We got oil is down 2%. Both corn and soybeans are down. Corn is down a little over 0.5%. Soybeans down nearly 2% on the day. Pound dollar down 72. Euro dollar down 181. Euro pound down 82. I'm gonna come back to that one. U.S. yen down 68. Euro yen down 2%, down 288 pips. Aussie yen up 42. Aussie dollar up 63. Bond slightly up. Dollar index slightly up. King dollar stronger. Pound yen down 1%. Big story of the day is the Swissy. Insanely massive move. And I want to basically open a chart and show you why and what happened. And affected, Euro franc, dollar franc, all that. But the real story is inside the Euro franc actual chart itself. And of course, you can see it on the other franc pairs and affected everything. This is we'll just go, 5-minute chart right here. This is literally a 5-minute chart on the Euro franc. We're talking a very, very small range. It just went up 30 pips, but basically they've been holding it. Right here, you can see since really beginning of January right here. We'll just look at this and see it. They've been holding it right at 1.2, maybe a little bit, higher, but basically above 1.2. And they, meaning the actual, the Fed of the Swiss Franc, they went in and they said, hey, this is where we're going to keep it. We're not letting it drop below this, and they've been keeping it there. So they've been going in and doing whatever market manipulation they need to do on the currency in order to keep the price up there. So why? Well, they didn't want it to go in and make their stuff too strong and then mess up imports, exports, all that stuff. It's the whole currency thing, currency wars idea. And they had this very, very, stiff proposal on it. However, this morning, the Swiss bank chief went in and abandoned the currency cap on the Euro franc. Okay? And basically says, we're facing a tsunami, da-da-da-da-da, goes and defends it, and he makes this big attempt, but basically what he does says, we're not going to do the cap anymore. We're not going to support it at 1.2. Well, right there, it drops massively. Let me add on, so I can just use a little ruler to help you see this. Let's see here. We'll go into toolbar shortcut here. Keeps making that window a little bit bigger than it needs to. All right, and so right here, we see a move in, 5 minutes or less, pardon me, of 254 pips. That's big. That's insanely massive, okay? And then when everybody realizes exactly where this is going, we don't see a drop. We see literally a gap. Biggest gap I personally have ever seen in any market. And so let's zoom in on that. Right here, use our zoom button. All right. And I'll back out the bars a little bit. When that prop stops, it gaps down 1,321 pips. So literally 1,321 pips after the initial gap. So the total change from literally in 10 minutes went from that to 1,573 pip gap. That's right, 1,573 pips or ticks, okay? This is what Fed interference and lack of Fed interference on a surprise market does. it blew a lot of traders up, I'm sure. Probably weren't trading the Euro Franc if you're an active trader. I mean, it just wouldn't make a whole lot of sense. I mean, like, there's the chart, right? It's up and down a tick, up and down a tick. But what do you trade? Well, you may trade the dollar franc. Okay, they've been propping the Euro Franc. Dollar franc, it has some movement. You go in, you can trade it. Okay, dollar franc, gap, down 5 minutes, 1,297 pips. And you're not getting out. I mean, I don't care where your order is, you're not getting out of this order. Okay, like if you're long, which you easily could be, I mean, is that theoretically possible to say, based on that chart, you'd be long? I mean, it's going up, right? Pop. If we go in, we can look at, I mean, there's multiple combinations of the franc. There's, dollar franc, euro franc, you got pound franc. Pull that one up. Again, decent volatility, very tradable instrument. Euro franc, not so much, but these instruments you could, but the franc itself is what moved. Goes on down. 2,089 pips. It's a matter of minutes. And like I said, very good chance you didn't get out in this section right here. I mean, just because it was so lightning fast. You might have, but if you didn't. Now, what is cool is, I mean, this did last a few minutes. Let's go down. Let's drill down to like a 1 minute chart on here. Got 1 minute where it's like pop. Now, I don't know about you, but that's going to be a pretty hard trade to hop into. The thing just dropped. Literally, I mean, if you're watching this chart, let's put it on the, like, you're right there. Okay, it's like tick, tick. I'm not talking about, we're on pure minutes here, okay? Boom. Should I sell? Should I buy? Should I get out of the way? Right? If you happen to be watching this, 392 pip drop, and there's no indicator that's going to deal with that. Okay? So, what do you do as a trader? Because this is what scares, and should rightfully so scare traders, especially when they're trading with leverage. Pound franc, dollar franc, euro franc. I mean, and this can happen. We've seen flash crashes. We've seen all sorts of crashes. Never seen a crash like that. That's a crash that, margin calls people all over the place. Whether it be market makers, whether it be traders, hedge funds, I mean, on down the list. If you're watching this chart and you're going long, like I said, you probably got demolished. If you're a Nadex, your risk was capped. Again, your risk was completely capped. So you don't have to worry about it blowing through a stop or anything of that sort. And to worry about weird freak events happening like that, the risk is capped. I mean, yeah, you could lose everything you put in, the risk you put into the trade. But let's say you have 500, or let's say you have $20,000 in your account, whatever. If you put $100 risk in, the most you're going to lose is $100. If you put in $1,000, the most you're going to lose is $1,000. Now, you could limit that risk. You could get out, potentially. I mean, a move like that, probably not, right? But that is your capped risk. It doesn't matter if you set a stop or didn't set a stop, okay, on spot Forex. I mean, it just flew. But with a capped risk product, like a call option, same thing, like buying a spread, buying a binary, whatever. If you happen to be strangling the contract, well, then you're in a really great scenario because the thing maxed out in value, right? So there's a lot of different ways that you could have been playing it and actually been profitable. But I like to bring this point up. It's one of these really, really scary lessons. That comes out, and it's just you can't get it across strong enough. But I mean, you don't want to scare people out of trading, you know, because I mean, it's not like this is a daily event, but it's one of those, like, anything can happen. I mean, black swan that all you want, but anything can happen. And let's see here. What do we got on that? Okay, let's see here. I want to pull this chart up. Give me 1 second. Okay. Anyways, anything can happen on here, and you need to be prepared for it. What can you do? I mean, there's some things nothing you can do to be prepared for them, but again, if you're trading with a captor's product, this doesn't have to, like, scare you to death. So even if you're using it just as a hedge, you know, like you're selling the spread to buy the FX or whatever, that's, you know, that's there. And like, I don't want to overstate it. I don't want to make it like just scary as can be, but I do want it to be that point that drives home one of the reasons that I do like trading. Now, I trade futures, I trade Forex, okay? Trade a lot of Nadex. But this point right here, more than any point I could ever make, drives home why you want to use defined capped risk on all your trades. Okay? This was on the just regular basic the LIBOR rate was going to come out at 4.30, their interest rate, the Swiss interest rate. So we'll come back to it. I was answering a question in the room, but was this a scheduled event? It was at 4:30. It was scheduled to come out, the interest rate itself. So right as that interest rate came out, that's when that announcement was made. That's when the market just took a nosedive. And the chairman had a speech scheduled at 7:15. We'll be back right after this. All right, folks, welcome back here to the Diagnostic Trading Hour. So just going over that Swiss National Bank release. I was actually reading over one of the press releases right here. But basically, they went in and they discontinued the minimum exchange rate, 1.2 euro versus dollar, and they lowered the interest rate to negative 0.75%. Yeah, so by 0.75. So the Swiss National Bank, I'll go ahead and just read this to you for those that are listening in your cars. The Swiss National Bank is discontinuing the minimum exchange rate of franc 1.2 per euro. And as I showed you on the chart earlier, we had that euro franc chart at 1.2 and then just that massive drop. At the same time, it is lowering the interest rate on site deposit account balances that exceed a given exemption threshold by 0.5 percentage points to negative 0.75. It has moved the target range for the 3-month LIBOR further into negative territory, basically costing you may to have cash, to between negative 1.25 and negative 0.25 from the current range of between negative 0.75 and 0.25. The minimum exchange rate is introduced during a period of exceptional overvaluation of the Swiss franc and an extremely high level of uncertainty in the financial markets. This exception and temporary measure protected the Swiss economy from serious harm. This is so bogus. While the Swiss franc is still high, the overvaluation has decreased as a whole since the introduction of the minimum exchange rate. The economy is able to take advantage of this phase to adjust to the new situation. What, a 2,000 pip difference in less than 5 minutes? I don't think so. Recently, divergences between the monetary policy of the major currency areas have increased significantly, a trend that is likely to become even more pronounced. The euro has depreciated considerably against the dollar, and this, in turn, has caused the franc to weaken against the U.S. dollar. In these circumstances, the Swiss bank concluded that enforcing and maintaining the minimum exchange rate for the Swiss franc against the euro is no longer justified. It's basically, since the euro is getting weaker compared to the dollar, then they don't need to enforce keeping it there versus the euro. The Swiss National Bank is lowering interest rates significantly to ensure that the discontinuation of the minimum exchange rate does not lead to any inappropriate tightening of monetary conditions. Like, too late. The SNB, Swiss National Bank, will continue to account of the exchange rate situation in formulating its monetary policy in the future. Be aware, this may happen again tomorrow, aka, not really tomorrow, but in the future. If necessary, it will therefore remain active in the foreign exchange markets to influence monetary conditions. So we've done this because we don't think it's necessary. if we need to change it back, we will. Okay. But I mean, that's the main thing that you need to understand. Like, that's what they just did. They changed it, and they also warned you that they may change it back, ultimately. And they shouldn't have interfered in the first place. And now that they did, they caused an even bigger mess in that process. Right? So, going up. So let me pull that chart up just to show you this is about the euro franc, really, because it's about them supporting it against the euro, and then it's also about them dropping their interest rate. So there's both pieces of that combined. And let me see here. I'll grab this. And so you can just see the flat market where they were literally just falsely holding up the euro versus the franc, trying to keep the franc weak against the euro. They didn't want it to get overly strong. So when it drops, I mean, the Swiss franc just got really valuable. Makes other things get less valuable. Hence why you see like changes in, gold and silver and stuff like that today as well. Okay. So because it basically by impacting that, it made franc got stronger, therefore dollar got weaker, euro got weaker, pound got weaker. So it's a whole like blow up ratio. But anyways, just so that way, you can see that, you understand what's going on, how it works, and why that massive drop happened. It wasn't just like, oh, I guess somebody sold a big position. It's like, well, yeah, the Swiss National Bank did. So anyways, but all right, well, that's probably enough on that story. But I wanted to explain it to you. People are going to be, gives you something to talk about, right? And just lay that out there. Okay. So that's what happened. It affected really everything, but obviously that would be the primary area you're looking at. What other impacts? Let's talk about some other impacts. CME, they double and then tripled their actual dollar franc margins. So if you're trading 6S, they went in, and so that's another impact. That's something you need to be aware of as a futures trader. I guess I'm trying to like go through all these ideas I can to share with you so you can learn from it. A lot of y'all probably weren't in it 4:30. So, okay, we'll talk about the margin thing here in a minute because I know that's sort of a new thing for a lot of people. So we'll talk about that when we get back right after this. All right, welcome on back here. Another thing that came out, CME released a performance bond requirement out to its members. And so right here, I got the link up here at CME Group, tools information, look up advisor. It's deep into it. But anyways, there's a link you can go to. It shows you even to get notifications, performance bond, margin changes. And so if you go grab that link there. But anyways, it's really an important thing to understand what's going on. The rates will be effective after the close of business on Thursday, January 15th. Okay, so we're gonna go from a current maintenance to a margin, and what you want to see here is the massive change. Okay, so we're going here and we're seeing like going from 225 up to 450, doubling. Okay, today after the close. All right, and there's all these different scenarios between different ones, but I mean, if you go here to Swiss Franc futures, I guess that'll be the easiest one to focus on. Going from 2250 to 4500. Okay, so 2250 to 4500. Those are the micros. These are the the main contract. Go down a little bit further. So that's today, and then they're going in and they're going to double them again. Not completely doubled again. The micros are still increasing, but 3 times. Basically, it's 3 times from the original requirement. They're taking from 4500 to 6750, and this will go into effect on Friday. So they've doubled them now, and they're going to go in and increase the rate again tomorrow to 6750 on that new maintenance requirement. So massive increases in the margins, and that's going forward. That's not just like now. So like they've doubled it now. Meaning if you have an account and you had a futures account and you were in a trade and you're like, oh, my requirement is 2200. It's 4500 right now. So I hope you have the money, or margin call can go into place, close out position, etc. Okay? Well, you should have that much anyway, but beside the point of they just doubled the margin. So understand margins can increase when you trade futures, intra volatility. Now, spot FX would stay the same, like 50 to 1, okay? But margins on futures can increase if volatility becomes very erratic. Because with moves like that, I guarantee you CME has a lot of money to collect from brokers, and brokers have a lot of money to collect from people right now. Okay? So these margins are going in to help those collections come in like now. And then they're increasing it even further tomorrow. This course would lead to what? Many people closing out their positions. Either by choice or forced to, based on this margin. I mean, think if your margin yesterday was, for a full-size contract was 22.50, but by tomorrow is going to be 67.50. Okay, now eating up 3 times the amount of capital. I want you to be aware that that can't happen. We saw this a lot in 2008. It's been a while, but we've seen it a lot in 2008. Okay, but like I said, my main point is I just want you to understand that that can happen, and it's posted, and that's what is happening right now. So if you are trading Swiss Franc futures, be aware of the increased margins. What I tell you, though, is margins on Nadex never go up. Your initial risk is your maximum risk and is your margin and never changes because it's always capped. Okay? And let's see here. That's trying to go what else. Let's see. Going on this, there you have it. They're raising margins now. Let's see if gold takes the hit now. Yeah, so I mean, with those margins coming out, this being released, you'll see this came out. It came out a couple hours ago, so it's not brand new news, but about 2 hours ago they put this release out. So, anyways, but just be aware of that and understand that your margins can change. It's these things that you have to know about futures. Like margins can change, margin calls can happen, anything can happen. Rarely does this stuff ever happen like this, okay? But knowing that it can, it will, that's also why you use proper risk management, have proper account size. That's why maybe you hedge off with options or use options as a alternative way to, trade futures and Forex. Okay. The only way you could take advantage of it is if you're looking at like the LIBOR rate. I've had quite a few trades go off this morning. Was happy with the results, mainly strangles, but the interest rate was coming out, and it's one of those like either they're going to work really well or they're just going to get whatever, and they worked really well because they surprised everybody. They did a massive interest rate change, and that's about the only way you could have taken advantage of that, unless you were just quick on the draw and you were comfortable with shorting after you saw the market drop 400 pips to watch it gap the next 2,000, which, if it can move 400 pips down, it can also move 400 pips up right against it. So not a wise move, like unless you're doing something with some sort of defined risk contract. And if you were going to do it, you would have had to be in it pretty much before it happened. Okay, so margin. What is margin? Some newbie questions, out there. You're getting into futures. What is margin? Margin is how much you put up to trade something. So if you trade a stock, like what's called a cash account, if stock costs $100, you put up, $100. Okay, so if you want to buy 100,000, where do they put up 100,000? Most stock accounts have what's called Reg T margin, and that basically means you have to put up half of the value of the stock. So if the stock costs $100, you have to put up $50. Okay. Now it's worth 100, but you only have to use 50 to buy it. Okay. Now, if you only had $100 in your account and you bought one share of stock for $100, okay, 50 of it's tied up in margin. You got 50 sort of floating there in P&L. If the stock lost greater than $50, then they would say either deposit more money or we're closing your trade. And most time they don't ask you if they're going to close the trade, they just close it. And sometimes they don't get a chance to close it, like when it moved 2,000 pips. Okay? So that's what margin is. Margin is basically being able to leverage your money to be able to use 50 to buy $100 worth of stock. We go over to Forex, spot Forex, you get 50 to 1 here in the US. So basically to control $100, you put up $2. Okay? So you can control a very large amount of money. So to control, 10 grand, you put up $200. Okay? It allows you to leverage that well. So I put $200, I control 10,000, euro dollars, and I can make more money in smaller movements. Okay, that's all a good thing. As long as you don't over leverage that account, your risk shouldn't go up just because you can buy more. Okay, like margin is there to free up your capital for various trading opportunities, to make it where you actually have the chance to go in and take advantage of small market movements, but actually make a decent amount of money, so long as you have proper risk management with it. So if you go on over to, it used to be 400 to 1. Now it's 50 to 1 here in the U.S. So, and even 500 to 1, like a long time ago, back in 2008. In Europe, you can get 400 to 1. Some places you can get 500 to 1, which at a certain point becomes crazy. And then same thing on like CFDs. You can go in, you can get capped risk, and so therefore high leverage, certain places at least. And then the other markets to look at would be obviously the futures market. And so, like, what is the size of the contract? Okay, is what you would do. So if we dove into CME over here, and just show you like sort of how to find the information. Go to FX, go down to our majors, go down here to the Swiss Franc futures, and you can go over here to contract specs, and basically tell you it's 125,000, Swiss francs. What is that worth? Per tick, 0.001 per Swiss franc equals $12.50. Okay. So you got franc dollar versus dollar franc. But anyway, so basically it's $12.50 a tick. But I had to control 125,000 Swiss francs with, what we looked at just a second ago, a couple $1,000 if I'm, holding a position, right? 2250. So literally controlling 100 grand with 2250. If I had $5 in my account and I lost, say, 3, then, and I had to have 2250 in margin, then that would subtract it below it. So I have $5. I got to put $2,250 up. Okay. So now I have $2,750 in available cash. 2250 is just tied up, like they're holding on to it in case something like this happens. Is the idea. Okay. But they're not planning on something like this. But in case they're planning on like a 2 deviation move. So they're tying up $2,250, and I have $2,750 left in my account, free cash. If I lose more than $2,750 on my open trade, then I won't have any extra available cash because 2250 is tied up. So let's say I had $2,750, the market pops against me. Let's just make it easy by I lose $3,000. Okay, like real fast, boom, drops down, $3,000. Well, now I'm negative 250 on available cash, but I have 2250 in margin. So either I close, they close my trade, the broker. They're not required to, but they desire to. Okay, so either me or they close the trade, 2250. They close it out. I dipped into that margin by 250. Remember, I had 5. They tied up 2250, but I lost 3,000. So if I had 5 and I lost 3,000, I only have 2,000 left. So if the trade's able to get closed out, then they return $2,000 back to me, but my position is closed. I can't reopen that position because I need 2250 for when I open it and hold that position. So it's just margin held. Now, so we understand we got 2250 held. We have $3,150 available cash. If I lose $500, then I'll have $3,250 cash, right? If I lose $750, I'd have $2,000 in available cash. So if I have $2,750 available and I lose $750, I'd have $2,000 available cash. It's live. So basically the margin is money set aside in case it moves so far against you, you have no available cash to help it to where you don't have to send them a wire, because they don't want to have to be out collecting like, hey, you just went negative, now we got to go get, we need you to send a, 500 or 1,000 or 10,000 or 5 million. I mean, size of your position, literally, over to us. Okay. So understand there's a floating P&L. So if I make 500, hey, now I have 5,500 in my account, but 2,250 is tied up. Make 1,000, now I have $6,000 in my account, but 2,250 is tied up. If I lose 1,000, well, now I have 4 grand in my account, but 2250 is tied up. So margin is what's tied up that can't be used. It's that hopeful stopgap measure that if the market were to quickly fast move against you, that it would cover any losses you had. So you couldn't go down to 0 and then negative is the goal of margin. Well, the CME decided today, like I said, to go in and raise those numbers up. Part of that is to force out closes. So that's going to happen today. They're going to close them out. And then when those new rules come in, they're going to close them out. So far, the only span requirement I've seen is on the franc. The only thing that they've changed is on the franc. They're franc listed contracts. I haven't seen any kind of changes on gold margins or anything of that sort. I mean, they haven't had, like, gold, there's no need to. To show you why, one of the questions come, well, what is it? Should this be on the franc as well? I mean, is this on gold as well? Okay, we have a 13% move on the euro franc. We have a, dollar franc. You know, we have a 14% move on the euro franc. All right. We have a, type right. There we go. We have a 13% move on the pound franc. On gold, we have a 2.5% move. I mean, that's not a big deal. So, I mean, it's a nice move. It's a great move. I mean, there's no crying about 30 points in move, but that kind of volatility is not abnormal. 30-point move. I mean, within, a couple deviations, they're not going to do it. It's when it breaks the deviation model, that's when the margins will go up, when the deviation model is broken. Or if there was actually a clue this was going to happen. Like if we go over and look at gold, for instance, just to show you standard deviation here. And not standard, but implied deviations. And look at the deviation levels. Yeah, we moved 2 deviations today. So margin is actually built in, ideally, to cover a 2 deviation move. Let's see how accurate they are. All right, so we can go over here and go, what is that move worth? That's 31 points. That's basically $3,100. Okay. And I'll pull back up metals, and we'll look at what the margins are and how they line up with their risk, the CME's risk model. Stay there. We'll be back right after this. All right, folks. Welcome back here to the Diagnostic Trading Hour. Looking at this, the question I said is, or basically the statement I said is that the maintenance margins are built basically on the concept of a 2 deviation move in the market. That's how they build the risk models. Okay. So what I did was I pulled up the implied deviation levels. We hit 1 deviation. You can see where we paused here. I'm looking at gold. Moved around, popped up, came back down, like moving all around, up and down between 1.5 and 1, then pops on up to 2, comes on back down. Really haven't busted through the 2 deviation level. Okay. So what is that value? Well, 2 deviation today was basically 30 points. So a little over $3,000. Okay. 31 points. The maintenance margin right here is 4 grand. So, standard deviation may be 40 points right now. Implied deviation says 30 points for 2 deviation move. So they built that model based on that right there. So now let's take the same idea. So the reason I bring that up is when the trader said, so does this impact gold? Will this impact gold, margins? And it shouldn't, because gold is staying within that 2 deviation normal model. We take that, we go back over, and we look at dollar franc, or franc dollar. Actually, let's pull up success. You can already see right there, though, how we broke 3 deviations on the first move. Right there, I mean, it's just like pop. Let's see here. How can I make this? It's so there's no way to stretch it out. Let's see here. It's just so big. Like there's so many ticks on that screen. Okay. There we go. So let me do this, and then maybe I need to shrink it down first. Do this. Move this up here. There we go. Okay, make it measurable. All right, so what is a 2 deviation move on, say, the dollar franc or franc dollar there? 152. And as we showed earlier, they're requiring 22.50, so a little beyond, it's actually a little higher than a 2 deviation move. All right. So basically, when they say, oh, let's see, actually it's 152 pips. Let's see, let's go in and do some more math on that. They may not even have it that big. They might not have that like anywhere near where it needed to be. But pull this up, because every tick is for $1,250, $1,900. Okay, yeah. So 152 pips times 1250 is 1,900. They're requiring 2250. Okay. Now I'm using implied deviation, which is more sensitive to where the market's at. They're using a standard deviation model, which is historic precedent. Okay. So there's maybe a little wider, but they pretty much leave it at the same model. You don't see it change too much, but unless things like this happen. But built on a 2 deviation model, 2250. And right now we're saying a 2 deviation move would be a $1,900 margin. Okay. So they have that margin just slightly above that. That's how they build that model. So unless that model is being broken, such as flying past, really like you start getting past 3 deviations. I mean, this is, I don't even know how many deviations is this, right? So, I mean, to measure it, we have to go, okay, well, what is 1 deviation? And then we have to grab the thing from settlement and go, how far did it move? So 2,469 pips. Okay. And then, let's see, bring it down a little bit more. It's hard to size this. Let's see here. All right. All right, well, it looks like we got 2,000 going into 71. So, I mean, you're literally talking like 25 deviation move. So it broke the model. They changed the rates. All right, y'all stay there. We have a great show coming up for you. And right after this.